Hello and welcome to Season 3, Episode 2 of the Talking Central Banks podcast with me, Karan Marishi. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be talking about the monetary policy tools and central banking in general of the Caribbean economies. Traditionally, the Caribbean has just been associated with its tourism and multicultural background, not so much about the fundamental monetary understanding that drives and backstops these macroeconomies. But I believe that an understanding of global central banking is incomplete without this piece of the puzzle. Moreover, today's episode is also necessary given the effective inflation management and strong economic fundamentals in the Caribbean economies, despite the global macro volatility and the damages caused by Hurricane Melissa recently. Our guest tonight is Jwala Rambarran, who was the governor of the Central Bank of Trinidad and Tobago between 2012 and 2015, and who is a distinguished Caribbean economist with extensive experience in central banking, sovereign debt, climate finance, and reform of the international financial architecture. He is a distinguished fellow of the Adaptation and Resilience Program and the Sustainable Finance Program at the Climate Works Foundation. Jwala is currently a member of the Task Force on Climate Development and International Financial Architecture, a global consortium of experts advocating a more development-friendly and climate-responsive approach to the IMF, the World Bank, and other international financial institutions. Jwala also serves as a senior advisor to the Caribbean Policy Development Center and to the managing director of the Climate Vulnerable Group of 20, advising on sovereign debt and climate finance, resilience, and reform of the global financial system. Welcome to the show, Jwala.
Thank you very much, Karan. Certainly a pleasure to be on your podcast.
My absolute pleasure, Jwala. So, starting with the challenges, in your opinion, Jwala, what are the main economic and monetary policy challenges currently facing the Caribbean economies?
I would say the challenges really stem from one related to structural vulnerability of
Right,
Caribbean economies. As you might know, Caribbean economies are classified and characterized as being small, highly open, very import dependent, and their production structures are really concentrated on a few sectors such as tourism, agriculture, offshore finance, and for a few economies, oil and gas. And that sort of structure really brings with it significant economic challenges because generally it means productivity growth is weak. Labor skills are generally constrained in a sense, although there are pools of some really strong labor expertise. Well, most importantly, in terms of what we see regarding climate shocks and external shocks, these generate tremendous challenges in terms of response, not only from central banks but also from governments. And one of the major vulnerability for Caribbean economies now relates to public debt. Many of these countries are highly indebted. The average debt to GDP ratio in the Caribbean now is about 70%.
right.
Compared to about 30 years ago, we were at about 55% of GDP. So there's been a tremendous jump. And with that jump in debt has also come an increase in debt servicing. So for some countries, debt servicing is around between 15 to 25% of core revenues. And that means, I think that's where the real challenge lies in that the fiscal space is now limited. There's less, we have less resources to put into, let's say, building out climate resilient infrastructure, building out social protection programs, and generally putting money where government thinks protection is really needed. And in that context, Caribbean central banks therefore have to manage across several objectives. As with many central banks, price stability is, of course, key. But
Right.
it also means that as small, highly open economies that are import dependent, managing foreign exchange reserves is also a critical challenge. And then with the issue with respect to facing repeated shocks, and having high public debt means safeguarding financial stability becomes key. There's also the issue of some of the more technologically sided risks that are emerging, particularly on the cybersecurity side, that will start to pose some challenges for Caribbean central banks. And then how we manage through the geopolitical environment, which, as you know, is one that is becoming fragmented. The multilateral framework that we were all accustomed to working within, that framework is one that is giving rise to more of a plurilateral type system now. And that means for many central banks, their monetary policy framework has to be a lot more credible, a lot more forward looking, a lot more driven by data. But that those frameworks also requires a level of complementarity that comes from fiscal policy, and where fiscal policy itself has to be more disciplined than before, and where we need to see the Caribbean as a space where more resilience investments need to be built out, especially in food and energy security. Yeah.
Right. So how does the small size, openness, import dependence, and limited diversification of the Caribbean economy shape the work of their
Mhm.
central banks, Jwala?
Yeah. Small size and openness makes and has made central banking unusually demanding in the Caribbean. And let me explain why. Because much of our consumption and production depends on imports, whether those are imports of food, fuel, machinery, intermediate goods. And that means that external price changes and exchange rate movements will pass through to inflation relatively quickly. And if we take the most recent shock, which is the shock emanating from the US-Israeli war on Iran and the associated closure of the Strait of Hormuz, we've seen that translate not only from a oil price shock, but we've seen that translate into a food, fuel, tourism, and aviation shock as well. So it's been transmitted across multiple channels. And what that requires Caribbean central banks to do is really they have to keep monitoring global commodity markets, shipping, tourism, remittances, foreign direct investment as closely as they would monitor the internal movements of money, credit, and interest rates. Yeah, so
Right.
it really puts Caribbean central banks in a very data intensive and forward looking mode. And the limited diversification of our economies then mean that a shock moves from one sector really to the broader macro economy. And if we look at, for example, when COVID took place and we closed off the economies, that shock of tourism itself being closed off meant that it didn't stay only in the tourism sector, but it it transmitted across the broader economy. When a climate shock hits, it's the same thing because it generates a hit on your most productive sectors, whether those are tourism or agriculture, for instance, and then that translates into a loss of foreign exchange. That loss of earnings puts tremendous pressures on your balance of payments and eventually on foreign exchange reserves, which then need to be used in support of the rebuilding efforts. So what you have is central banks having to work within these structural conditions that require them to use a broader policy toolkit. So whether that whole toolkit is the traditional policy interest rates, whether we say it's reserve requirements or open market operations, they also need to be uh, coordinating monetary policy a little more with fiscal policy. And that is not to say that that coordination comes at one where there's dominance between either side, but that central bank independence or more central bank autonomy has to be one that is respected, where governments continue to determine fiscal policy and the development part, but central banks remain um, within the mandate of preserving price, monetary, and financial stability. And that's the sort of balancing act that central banks every day are caught in the Caribbean region.
Talking a bit about externalities, Jwala. In
Mhm.
your view, how are geopolitical tensions, global interest rates, energy prices, and trade disruptions affecting inflation, growth,
Mhm.
and external balances in the Caribbean economies right now?
Mhm. Yeah. Well, I say the geopolitical tensions affect the Caribbean primarily through imported inflation,
Yeah.
external demand, and global financing conditions, right? We've seen how geopolitical conflicts, particularly, as I said, the most recent one associated with instability in the Middle East, right? How that conflict has raised the prices for oil, gas, fertilizer, food, insurance, and freight costs. And for energy important Caribbean economies, which are most of the Caribbean economies, this worsens the trade balance. It increases production and transport costs, and it places pressure on household budgets. And what that means is that energy importers may receive some temporary fiscal and foreign exchange gains, such as a Guyana, a Trinidad, and Suriname. But these countries also face significant volatility, production concentration, and the fact that um, trade itself is also being disrupted. And the next major issue is around the financing conditions, as we've seen these geopolitical tensions really eventually translate into higher global interest rates. What that does is then it raises the cost of borrowing for the sovereign and even for private institutions in the Caribbean. But as I said, because Caribbean countries are highly indebted, the increases in global interest rate then translate to higher debt services, right?
Correct.
The debt service burden widens, the interest rate differential also widens, and therefore there's a possibility of capital outflows for Caribbean economies. So Caribbean central banks then face this the pressure to keep domestic interest rates higher than domestic demand conditions alone would justify, but they have to
Yeah.
look at what's happening on the external market. So that's that again, that sort of balancing act that they have to treat with. On the trade side, we've seen these geopolitical tensions manifest in supply chain disruptions, and that obviously reduces tourism. It also sort of lowers investment confidence. And what it does, it exposes the region's dependence on a few suppliers and markets because, again, um, we have limited diversification. And so the result is generally this uncomfortable combination of weaker growth and higher inflation and even prospective inflationary pressures. And so for central banks in the Caribbean, the typical response is not simply one of tighter monetary policy through higher interest rates. Yes, they would look through the price shocks to see are those shocks likely to be temporary, and or are those shocks likely to become a lot more persistent, right? Where inflation then becomes a lot more wedded into expectations. And then, that means again, central banks have to take this judgment call in an extremely difficult environment. And it requires governments to also complement the central bank's monetary actions with more targeted support, whether that's support for vulnerable households, whether that's support for building out food and energy resilience, or whether that support is how do you start to diversify trade relationships. Yeah.
Very interesting, Jwala. So, what role should central banks play in managing climate-related financial risks, particularly given the Caribbean's exposure to frequent hurricanes
Mhm.
and other natural hazards?
Yeah. Um, so first, there's some context to climate risk in the Caribbean. Uh, the the Caribbean is situated within what we call the North America, the North Atlantic hurricane belt. Most of the countries are in
Yeah.
that zone, which really means that hurricane risk is critical. And what we've seen over the last 3 decades is a rise in the number of hurricanes and a consequent rise in the number of more powerful hurricanes, right? That would generally be in the what we call category 3, 4, or 5 hurricanes.
Mhm.
And therefore, that means that Caribbean central banks need to treat climate risk as a core macro financial risk. In other words, climate change is not separate as an environmental agenda, but it is becoming macro critical. And therefore, if it's becoming macro critical, central banks need to start to incorporate this into their frameworks. Whether it's the supervisory framework regarding financial institutions, or whether it's your inflation expectations type framework regarding price stability, these risks need to be incorporated. So the first requires Caribbean Central Bank to identify the risks, right? Um, they need to map not only what are the physical risks, but we also have what we call the transition risk exposure. They need to improve data collection and they need to incorporate these climate scenarios into their stress testing models. Um, for the most part, that is an area that is now emerging. It's new to Caribbean central banks, although you would say, but you guys have been facing these climate risks for decades, right?
Yeah.
But it is new. And you now see some central banks starting to think through how climate shocks could be incorporated into their macro forecasting, into their analysis of reserve adequacy, and how it could be incorporated into surveillance from a financial stability point of view. And that is really because I would say the last decade is where we've seen these more powerful hurricanes in particular generate this kind of macro financial shock. And,
Right.
Hurricane Melissa, which we could speak to after, is one. And Melissa was October 2025, but we also had Hurricane Beryl, which did tremendous damage in July of 2024. So in the space of a year, you had two major back-to-back hurricanes in the Caribbean doing damage. And if we just sort of pull back to 2019, Hurricane Dorian generated tremendous loss and damage in the Bahamas. And then you had Hurricane Maria, which hit Dominica in 2017. That loss and damage was over 200% of GDP, which made
Right.
Hurricane Maria the most the costliest uh, hurricane as a percent of GDP, not necessarily in terms of dollar value, but as a percent in terms of what the tremendous damage it did to a small island economy. So that then starts to put these risks and shocks inside, as I said, a macro fiscal type framework. Yeah.
So we will talk about inflation management in later questions, Jwala, but a question that comes to my mind from this response is that if that was the kind of disruption that was witnessed by these economies, were there any disruptions in supply chains? Was there any permanent impairment of capacity during this time?
It depends. For countries like Grenada, which experienced Hurricane Ivan in 2004, for countries like Maria, where similar, like Dominica, where Hurricane Maria created tremendous devastation. Uh, it took years, right, of rebuilding for um, Grenada in particular. After Hurricane Ivan, uh, its debt situation became unsustainable because
Right,
one of the major issues is that Caribbean countries typically finance their recovery and reconstruction through borrowing. And much of that is commercial borrowing, which one means the debt stock rises, but the debt service itself also rises over time. And so after just almost a year after Hurricane Ivan hit Grenada, Grenada's debt became unsustainable and it had to undertake a debt restructuring.
right,
That debt restructuring was not complete enough. And almost 10 years after Hurricane Ivan, Grenada had to undergo another debt restructuring. Right? So it
okay,
shows how the impact has lasted for a long time. Same thing in respect of when you look at what has happened to what Hurricane Maria has did to Dominica, and it's now a highly indebted country, and therefore it has to at some point start to treat with its debt. Yeah. So for many of these countries, the most immediate impact you will see from a macro point of view is what happens to debt. Yeah. Right. There's a really strong debt climate nexus in the Caribbean.
and this debt is dollar denominated, Jwala, or is it
Ye-
domestic currency
Um,
denominated?
it's a combination of both.
Mm.
Generally, I would say, depending on the country, about 60% would be dollar denominated, and the
Okay,
rest comes from within the domestic economy, where there would be financing coming from domestic banks, and in some cases, recourse to the domestic social security system, which again, in
right.
itself, is another major challenge that has to be dealt with. Yeah.
So that means that the external debt ratio goes up, and that has implications on the sovereign rating as well.
Yes, it does. Yes, it does. That's why most Caribbean countries that are rated carry non-investment grade rating. And as you
Right.
could appreciate, as soon as a debt restructuring is announced, then they move to default mode. Yeah.
Okay.
Until the restructuring is complete, and then we see what's the outcome. But then they generally still go back to a lower non-investment grade rating. Only at one point, only Trinidad and Tobago and Barbados enjoyed investment grade ratings. Yeah.
Very interesting. Yeah. So, how important is climate risk in the central bank's Taylor rule function, Jwala? I mean, do you guys have managed to incorporate that in the function?
Uh, Caribbean central banks don't generally use this conventional Taylor rule, which links your policy interest rate to uh, how inflation deviates from target and how,
Right.
there's what's the output gap in relation to potential. Uh, but but they do recognize that climate shocks would obviously affect both variables, inflation and potential output. So what you more see is Caribbean central banks operating in more of a, I would say, a augmented policy framework, right? That would have shades of a Taylor rule. Because climate risks will then start to enter into the central bank's forecast through expected inflation, the
Mhm.
output gap, but also considerations on the exchange rate, because many countries run at the end really fixed exchange rate systems,
Mhm.
uh, fiscal reconstruction spending, and imported inflation, because of course, as you could appreciate, that spending then translates into heavy imports, and then what that does to the sovereign risk premium. So what the central bank would seek to do then is to really balance those risks around the inflation forecast and the speed at which inflation then is expected to return to what target the central bank may have for inflation. And at the same time, like many other central banks, it would have to distinguish between the first round price effects from the persistent second round inflationary effects. And again, that's why for many Caribbean central banks, it is not simply how monetary policy reacts by raising interest rates, because that assumes that capital markets are well developed, which is not in the Caribbean. And that what's the nature of the shock? Is the shock that one that originates from, let's say, an agricultural shortage when the, let's say, when the climate risk materializes. Let's say like for example, when Hurricane Melissa hit Jamaica, um, a good bit of the inflationary pressures that you're seeing are coming from the supply side in respect of food. But if you raise interest rates, right, to combat
Yeah.
that inflation, it does really nothing in respect of how that shock originated, because raising interest rates doesn't do anything to deal with temporary agricultural shortage, and it doesn't restore the crops right on the
Yeah.
ground. So again, it's not the general sort of reaction that you will see in a more developed economy and a more advanced economy central bank, where okay, well, interest rates are then going to be raised because we see in signs of high inflation. Caribbean central bank will actually work a little more in detail as to what's causing that, right? And you would have seen that sort of thinking coming through when the Bank of Jamaica started to make its monetary policy actions after inflation started creeping in respect of Hurricane Melissa. Just something we could talk about after. Yeah.
So, from the prism of the Mundell-Fleming trilemma,
Mm.
Jwala,
Mm.
if the Caribbean central banks are controlling exchange rate and they have a fixed exchange rate, as just mentioned,
Mhm.
and then you might have independent monetary policy, then the capital flows are not under the control of the central banks, right? Then,
Mm.
and that would sort of have an implication on the currency inflation in the
Mm.
longer or the medium term.
And that is where you see Caribbean central banks have to work through this sort of trilemma of having essentially fixed exchange rates.
Yeah,
Um, they were
independent monetary. Yeah,
independent monetary policy and what happens to capital. And that's why most of the countries outside of Jamaica, Trinidad, and Guyana, their capital accounts are closed because that's
okay.
the only way that they could manage on that last part of
Yeah,
that impossible
mm,
trinity, as
yeah,
as we call it. And it
mm,
really, but part of it is also, I mean, from an economic point of view, you say, well, that doesn't make sense. You need to open your capital account. But again, if you look at it, as I said, at the structural vulnerability of these economies, if you open your capital account, then in a way you've lost not only you don't only give up a sort of policy autonomy from the central bank side, you then give it up at the broader level. So I think, so it says that for economies like ours, there has to be a level of discretion built into the policy framework. It can't be where you have a strict fixed target, and that's what you're operating with. Yeah. Yeah.
okay,
Central banks will require a greater level of discretion than you may
right,
see in the more advanced economies.
right. Can you talk a bit about the impact of Hurricane Melissa on
Mhm.
the Jamaican macroeconomy specifically, Jwala, and steps taken by the central bank to manage the rebuilding process and shoring up market confidence after that?
Mhm. Yeah, sure. So Hurricane Melissa was a major macroeconomic shock to Jamaica. Why do I say that? The total estimated effects of Hurricane Melissa, meaning counting physical damage, loss, and additional costs, those have been estimated at about 12.2 billion US, which is a small number in the context of things. But in the context of the Jamaican economy, that's 57% of GDP. So more than
Right.
almost 60% of the country's GDP was impacted by Hurricane Melissa. And that meant that Melissa was a major economic shock. And for Jamaica in particular, especially on the debt side, Melissa has been in a way a game changer. Um, because Jamaica was one of those countries that was considered a success story when it came to reducing debt. It managed to bring its debt down from about 125% of GDP a decade ago to about 62% in 2024, just before Melissa hit. So it really was bringing that down and almost a more sustainable growth, a sustainable path. Now, much of that, the rebuilding and reconstruction for Jamaica has to be done through borrowed funds. And that borrowed funds means, well, at some point, debt is likely to rise. The medium-term projections suggest that debt will is not likely to rise significantly, but is going to remain somewhere above 65 percent of GDP. Even if you look at what we call the primary fiscal balance on the fiscal side now for Jamaica, um, it it always ran a strong primary fiscal surplus. Now Jamaica is gonna be running a fiscal surplus that is really low, which means that the medium-term baseline has actually been affected. In respect of the Bank of Jamaica now having to come into that context, was its role, and its role remains: how do we preserve monetary and financial conditions while this major rebuilding and reconstruction effort is taking place over this period of time? And we're looking at least a five-year horizon for the central banks. And that means for the Bank of Jamaica is, how does it keep, one, inflation expectations anchored? Two, how does it maintain orderly foreign exchange and money markets in the context of this major rebuilding exercise? How does it ensure that adequate system liquidity is maintained? How does it protect the country's reserves? Because the international reserves are projected to remain somewhere around five billion US, and that is going to come through based on also significant multilateral financial support from the IMF, the World Bank, the IDB, and other development banks. And how does this Bank of Jamaica ensure that there is no significant deterioration in credit quality, given the hit that various sectors have obviously taken from Hurricane Melissa? So again, so the Bank of Jamaica's major role is, again, how does it preserve that monetary and financial stability in the context of a macroeconomic shock hitting the country? Yeah. And it has and is doing that in the context of a framework, a monetary policy framework that doesn't exist in the rest of the Caribbean. The
Mm.
Bank of Jamaica is the only central bank with an inflation targeting framework in the Caribbean.
Okay,
Yeah, so right. So
interesting.
while other central banks speak to price stability in general, Bank of Jamaica has a specific inflation targeting framework that is part of law, and where there's a specific target around what inflation should look like. And therefore, it moves its policy rate in relation to that inflation target, right? And this is something that, we're gonna now have to see how is the lesson will be: is this inflation targeting framework serving Jamaica better than a general framework that just speaks to broader price and exchange rate stability? I think it's too early right now to tell, because we now moving into looking at how inflation is developing in Jamaica, what the Bank of Jamaica is doing in respect of its policy rate, and whether that framework will work well over the year and next 2 to 3 years. So it's a really significant test case for inflation targeting in the context of a macroeconomic shock in a small island economy. Really interesting space to look at how this central banking framework is going to evolve.
Absolutely. So just curious, Jwala, you said that Bank of Jamaica is the only central bank in the Caribbean which has an FIT framework.
Mhm.
So how does this cooperation among these multiple central banks in the Caribbean work? I mean, do you have some kind of an association or some kind of common target ranges that you manage? I mean, because generally the Caribbean ecosystem is considered to be a unified ecosystem, just like the European Union.
Mm-hmm. Yeah. Well, yeah, just like the European Union, what they see at times is this sort of unified voice, strong regional cooperation, and Caribbean central banks, are like that. There's significant cooperation amongst the central banks, particularly through what's called the CARICOM central bank governors. So that in itself is at the leadership of the central banks. There's this major interface that exists and and that has existed for, I would say, more than 2 to 3 decades now. Yeah,
Right.
right. So it's been there. So there's a strong institutional interface. And then there's also the Caribbean group of banking supervisors. So at that level, that next level of Caribbean financial supervisors, there's coordination. We also have the IMF's Caribbean Regional Technical Assistance Center called CARTAC that exists, that is there to provide that level of technical assistance.
Right.
So Caribbean central banks do cooperate. They do work around regional cooperation. They do seek to speak with one voice within the global financial architecture. But of course, there's significant room for improvement there. And I think what is needed now is for Caribbean central banks to start thinking through the creation of a stronger and common macro financial platform. Because one, the risk, as you see, as I've said, these risks are really macro financial in nature, whether it's climate, whether it's geopolitical, whether it's a COVID risk, right? And therefore, what the region needs is shared climate and transition risk scenarios. We need comparable supervisory data. We need stronger crisis management arrangements, and we need a collective strategy around foreign exchange because
Right.
that's key. Right. So what it really requires then is for Caribbean central banks to use and leverage that the regional um, institutions that already exist in to seek to build off this sort of common macro financial platform. But it also requires Caribbean central banks to also think about the fact that they share common vulnerabilities and therefore how you could strengthen the Caribbean's regional voice on particular technical issues that are affecting central banks and economies in particular. I could there are a few based on the work that I've been doing. One is how do we get greater access to vulnerability-based development finance? That's one. How do we incorporate climate and transition risk into debt sustainability analysis that's been done by the IMF and the World Bank? How do we incorporate more disaster clauses into sovereign debt contracts? And how do we then look at reforms that are being asked to the IMF, the World Bank, and other development banks? Right. So therefore, there's a lot then that Caribbean central banks could do in terms of leveraging what already exists to sort of create this greater regional voice uh, for the Caribbean in terms of macro financial stability and reform of the global financial architecture.
So there have never been any discussion regarding a European Central Bank kind of a unified central bank representing the entire region.
I smile because when I joined the Central Bank of Trinidad and Tobago as a young economist, uh, 30 years ago, 35 years ago, right?
Yeah,
Right. There, at that time, that's when Europe was discussing the formation of monetary union, and
yeah,
the Caribbean central banks decided to look at this issue of
mm,
monetary union for the Caribbean. There were tremendous technical discussions that proceeded. Right. A lot of work was done. I think we had like about 2 years of technical work that was done.
right,
The outcome was presented and recommendations were presented to the governments, to the heads of state. And the issue was really which central bank was willing to be the first to give up its sovereignty and join this pool.
okay,
And,
right,
and it meant then which government was willing to do that. And that's where it stopped, right?
okay,
Hopefully, over the years, there's been more, I would say, more maturity. We've seen more collaboration, as I've said. We've deepened the relationships amongst the central banks. Um, Perhaps eventually this might be something they may start to look at again and see how pooling of regional resources might be an avenue to deal with the the evolving risks and the structural vulnerabilities of Caribbean economies.
yeah. Maybe a contingency fund would be an initial response before the discussion of a
Before
central bank, common central
going
bank.
to that,
Yeah,
yes, and I think when I was governor, had done some work along those lines, looking at a Caribbean regional financial arrangement as a
right.
first step to
Yeah,
getting Caribbean central banks, involved in pooling some resources to deal with
yeah,
these shocks and to how we could then self-finance economies. So yes,
yeah.
you're quite right. Maybe, you know, uh, an intermediate solution is needed first. Work with that, see how it happens, and then we go to this deeper solution. Yeah.
Wonderful. Very interesting, Vala.
Hmm.
Can you please talk about the monetary tools frequently used by the central banks in liquidity management and overall effectiveness of monetary policy? I know you've talked about this, but maybe you can
Mm-hmm.
give more detail.
Mm-hmm.
Uh,
Mm-hmm. Mm-hmm.
yeah,
Um, all right. So generally, I mean, Caribbean central banks carry through with the same monetary policy tools as you'll have in a typical central bank, depending on those vary from, your policy interest rates to open market operations to carrying through repos. Some still work on reserve requirements. Some have standing lending and deposit facilities. And some may even do dependent, but that's really limited. Some, they may think about foreign exchange operations. And these are the typical instruments that they use to influence the amount, the price, and the distribution of liquidity in the banking system. What I think is most important, though, is that relationship that exists between government and the central bank in the management of liquidity and the overall effectiveness of monetary policy. And I'll use Trinidad as an example because I think is one that shows how those tensions are part of daily monetary management. In the case, as Trinidad and Tobago, as you know, is an energy-based economy.
yeah,
And that means there's a concept that we developed in the central bank called the non-energy fiscal deficit. In other words, our concern is not with the overall deficit as generally, other central banks would be. And that overall deficit means it has to be financed. Our concern is with the non-energy fiscal deficit because the energy balance is always in surplus and leads to a buildup of reserves. So it's always finance. It's the
Right.
non-energy part that's not finance. And therefore,
Right.
it is the government through its operations that creates that pool of liquidity for financing a non-energy fiscal deficit. And therefore, it is the central bank that comes in to the market to manage the liquidity that arises from that financing. And in the case of Trinidad and Tobago, what we've had now is a sort of relationship that has developed between the central bank and the Ministry of Finance, where we get that data on a quarterly basis. What is the government seeking to do in respect of its revenue and expenditure operations? And then
Yeah.
we take that, put that into the monetary framework and say, what's the liquidity that's likely to arise? And what's the baseline liquidity? And then how much of that liquidity could be considered excess in relation to the inflation numbers that we're looking at, and therefore what has to be taken out of the market in respect of open market operations, right? So
So
that
sorry to interject. Sorry
yeah,
to interject,
sure. Mhm.
Jwala, but when you talk about liquidity, then it
Mhm.
basically means the reserves are supplied by central bank.
Y- Yes, in the
Okay.
end. Yeah.
Okay.
Right. So it's that sort of framework that has to be put in place at the level of the central bank. But it does a number of things because why I use Trinidad and Tobago is one, it developed a concept that was important to and specific to the economy, to the structure of the economy. And it might be that for tourism-based economies in the Caribbean, right, it may not be again the overall deficit that they need to look at. They may need to look at the non-tourism deficit because the tourism sector is already generating the the US dollar liquidity that's packed away, right? The second is the degree of collaboration and coordination required between the central bank and the Ministry of Finance. I think that in itself is important because we generally think that in the larger economies, the more advanced ones, um, you don't speak to that level of coordination with the fiscal authorities. But in a small island economy, that is extremely critical to how you yourself would manage on your mandate. So for Caribbean central banks, that I think is extremely key. And as I said, Jamaica's experience now with inflation targeting will show us how that framework is going to evolve in the context of this huge demand for liquidity to finance a reconstruction effort, not in a 1 year period, but let's say over a 5 year period, right? And
Right.
how that is going to translate into inflation, how that is going to translate into demands on foreign exchange, and therefore how the Bank of Jamaica is going to react in terms of its policy rate. Yeah.
So staying with Jamaica, Jwala, I was
Hmm.
reading about Jamaica's macro numbers today,
Hmm.
and a few points were striking.
Hmm.
Firstly, the inflation has remained well managed and near the lower threshold of the inflation target range of 4%. I believe the target range is 4 to 6%.
Yes.
At the same time, Jamaica's currency has fared strongly against the USD. And this is happening despite the geopolitical uncertainties and commodity volatility that we were
Hmm.
discussing about
Hmm.
earlier.
Hmm.
Secondly, commercial banks have also remained well capitalized with sufficient liquidity, as shown by capital adequacy ratios, and the credit growth as a result remains very strong.
Mm,
And this is despite the fact that domestic demand is now a bit slacking. So the question is that what kind of monetary policy and liquidity management exercises have strengthened the macroeconomy, in your opinion?
mm, mm. Yeah. Um, well, first, Jamaica's inflation performance has been generally strong. But bear in mind that the annual inflation rate in June of this year was around almost 7%, which is just above the 4 to 6% target. And that's understandable because again, it reflects the post-hurricane and external pressures that we're seeing, right? The exchange rate itself has been relatively orderly rather than, I would say, permanently strong in a fixed way. And I think what you see in there is really the fact that Jamaica's inflation targeting framework has, and combined with the fiscal responsibility framework, right? So I think that's something that we can't look at um, just the monetary policy piece, alone. It it is being combined with a strong fiscal responsibility framework that has shown tremendous achievement. And that combination has led to significant reductions in volatility and an improvement in overall confidence in the policy framework, right? So one is that the Bank of Jamaica has been able to use its policy framework quite well and its policy rate to anchor inflation expectations. So while people say, yes, we know that inflation has gone up and we expected that to go up because there was this negative supply shock, particularly on agriculture arising from Hurricane Melissa, the expectation is that inflation is going to gradually come back down over the course of the year, right? And and I think the Bank of Jamaica itself, early in February, did reduce its policy rate to 5.5%. And it has held that rate there even in June, despite the fact that inflation has gone up, because it expects this to be temporary, right?
Mm.
And then the fact that foreign exchange intervention has been really focused on smoothing any disorderly conditions in the market rather than fixing a particular rate. And remember, again, it's the same thing. Uh, the tourism sector has picked up, has shown a strong rebound. And with that has been the fact that in foreign exchange inflows have been coming in. So it keeps strengthening the overall reserve position of the Bank of Jamaica. And again, that is what um, the markets are looking at. So what they're seeing is a central bank that is demonstrating that it is still working within its a well respected and credible policy framework. And the communications coming from the Bank of Jamaica are one that people are willing to say, the markets are willing to say, all right, we recognize what you're saying and we will give you the benefit of the doubt because you are demonstrating the sort of monetary discipline that is needed. Yeah.
So do you think that would mean that the rate of interest or the repo rates would remain high in Jamaica because they want to also sort of appear to be maintaining a competitive rate of interest
Hmm.
as compared to other
Yeah.
emerging markets?
Well, bear in mind the Bank of Jamaica did lower their policy rate early this year, right? And it's not a relatively high rate, let's say across the Caribbean, but certainly high relative to, let's say, the US and Europe. And that is
Right.
again keeping in mind that you want to keep a strong enough interest rate differential to prevent outflows. And I think that could be an
Yeah.
ex, um, That's understood now in the context of a rebuilding exercise where you need to have as much reserves as
Yeah,
possible. Yeah. Yeah.
yeah. So, Jwala, you were the architect of the V20 Lifeline Fund, a
Mhm.
pioneering liquidity mechanism designed
Mhm.
to close critical gaps in the global financial safety net for
Mhm.
climate vulnerable economies. Can you talk about this experience and the purpose of this initiative?
Mhm. All right. Yeah, sure. First, the Lifeline Fund was conceptualized given the significant gap in the global financial safety net. And let me explain what that safety net actually comprises, right? Really, at the global level, it is the you would have um, countries have access to either what we call the currency swaps, right?
Right.
They have access to regional financial arrangements, meaning arrangements created by central banks. There are few in the world. There are few in Latin America. We have something called FLA, the Latin American Reserve Fund. In
Yeah.
Asia, you have what's called Chiang Mai. You
Yeah.
have BRICS that also created the BRICS Contingent Reserve Account. So those are what we
Yeah.
call regional financial arrangements. And then you have the IMF, which is the lender of last resort. So in the global financial safety net, this is the access that countries would have when shocks hit and they have to finance those pressures that arise on their balance of payments. What we've seen is that when climate shocks hit, there is no similar recourse in the global financial safety net. Um, there is no currency swap that speaks to financing when a climate shock hits. There is no
Right.
regional financial arrangement that has facilities designed to provide support when a climate shock hits. And the IMF's only, there are two tools, facilities in the IMF when climate shock hits. And one is the Rapid Financing Instrument, the RFI, which has what we call a large natural disaster window, or the Resilience and Sustainability Facility, the RSF. The
Yeah.
issue is those um, facilities come with conditionality, right? So they're
Yeah.
not, in a sense, they're not free, easily accessible and affordable financing. So the global financial safety net didn't really have an instrument or a facility that was able to provide rapid, predictable, and affordable financing without conditionality when climate shocks hit. And this is why we conceptualize and we've developed and created the Lifeline Fund for V20 member economies. The V20 is the vulnerable group of 20. They're no longer 20 members. It started with 20 members. There are now at least 74 members in the group across regions. So across
Okay.
Latin America, Caribbean, Africa, um, Asia, and the Pacific, and some parts of the Middle East. So it's a
Okay.
multi-regional group. So what we did was the concept is really a simple one. V20 member central banks come together, pool a part of their reserves into this fund called the Fund. And that pooling will now create a larger volume of funds that are available for countries to, to treat with pressures on their balance of payments when a climate shock hits. And that financing is going to be rapid with within 2 weeks, right? Within 14 days, you will get financing. Financing will be based on the sort of vulnerability that we've seen when climate shocks hit their balance of payments and what that means, particularly to their trade position. So if you're more vulnerable, you're actually going to be eligible for a multiple of financing than if a member who was least vulnerable, right?
Okay.
And there's no conditionality attached to this. Yeah, right. So,
So in
so
yeah,
yeah. So please go ahead.
yeah, please. So would there be any financing from the Global Climate Fund as well,
Mhm.
which
Uh,
was initiated after the Paris Declaration?
yeah. The financing, the capitalization of the Lifeline Fund, about 60% is going to come from central banks. The other 40% is going to come from development partners, none
Mm.
from the multilateral climate funds. Yeah.
Right.
So there are certain development partners who've expressed interest in being part of this arrangement, and they could come into the space, provide the funding for capitalizing the fund. Yeah. The fund
Okay.
has a whole host of other things that have been worked through in terms of governance arrangements, risk management, fiduciary responsibilities, that sort of thing. Yeah. Those are being worked through, and at the UN General Assembly in this September, the final announcement will be made on operationalizing the Lifeline Fund. Prime Minister Motley of Barbados, um, as you know, Barbados chairs the V20 at the moment. They hold the presidency, and she will be making that announcement. Uh, It's a
Very
major,
interesting.
it's a
Yeah.
major initiative for the global south. We're showing that
Right.
rather than reaching out to the global north and asking for funding, we're showing that we could do this funding on our own. We could
Mm.
develop and build out institutions that are more fit for purpose. Yeah.
At this point, Jwala, I wanted to have your opinion on how do high public debt levels and limited fiscal space affects monetary policy, financial
Mm.
stability, and the relationship between central banks and governments in the Caribbean as a
Mhm.
region.
Okay, yeah. As I said, yeah, the Caribbean is a highly indebted region. And so high public debt obviously narrows the room for both fiscal and monetary policy. As you know, governments, if you have a large debt servicing, that means you have less capacity to respond to shocks, to disasters, or to even social needs as, as those needs would arise. What it also means is that when a shock takes place and you have to finance your way out of that shock, it's generally in terms of borrowing, which then leads to a higher debt level. And what that would then do, it really places tremendous pressure on the central bank to maintain low interest rates in the context of the rebuilding exercise, as we've been discussing in relation to Jamaica, for instance.
Right.
And this has the possibility that it could really create fiscal dominance, and where monetary policy becomes constrained by the government's financing position. And therefore, what that speaks to, let's say first in the context of a Jamaica, it really speaks to the need for having credible uh, policy frameworks. In the case of Jamaica, it has the inflation targeting framework. And in the case of the Jamaican government, they have their fiscal responsibility framework. So it actually shows how policy frameworks are critical when we start to treat with the impacts of debt. But debt also affects financial stability, which is a mandate of Caribbean central banks, because, as you know, many Caribbean financial institutions hold substantial amount of domestic sovereign debt. And therefore, if there's a deterioration in the credit worthiness of the sovereign, then that weakens the balance sheets of banks, and that could lead to some banking stress. So there's also apart from that climate nexus that exists in the Caribbean, there's a significant sovereign bank nexus that also exists where the link is um, public debt. And when you start to think about then monetary policy and the sort of monetary policy decisions that a central bank should take, high debt obviously complicates the sort of interest rate decisions. Because if you want to raise rates to contain inflation, you then end up raising interest rates on government debt, which then raises government
Exactly.
debt service. Yeah. And if you
Yeah.
keep interest rates too low, saying, well, I don't want to have that impact on that, you undermine your currency because you're running fixed exchange rates and you undermine reserves, which you need to build up. And you also undermine inflation expectations because you need to generate a certain amount of price stability. So public debt really shows that interface between central banks and the ministries of finance and why the need for central bank either greater policy autonomy or greater independence is important and why having clear and specific mandates are also critical for central banks.
Right. So, how can Caribbean central banks deepen regional cooperation and strengthen their voice within international financial architecture?
Mhm.
Basically, what is missing and
Mhm.
what steps have already been taken, in your opinion,
Mhm.
apart from the discussions that you mentioned
Mhm.
occurred as part of central bank integration and a common monetary
Mhm.
policy union,
Yeah,
monetary union?
yeah. I think um well, I spoke around the need for a stronger common macro financial platform. I spoke around the need for central banks to speak with one voice, Caribbean central banks on issues such as vulnerability-based access to development finance. I think the next steps really should be, yeah, more practical steps like creating a regional working group with defined deliverables around, um, let's say, debt sustainability assessment. I think that's key because what has happened is the typical IMF debt sustainability assessment does not include climate. And
Yeah.
if it does include climate, it treats it treats the climate shock as something coming from the outside rather than one that is endogenous and creates a macroeconomic implication. And and if governments are actually attempting to fund their resilience and build greater resilience to these to the climate shocks, the DSA treats that as an expenditure, not as investment. So there is need to reform the IMF DSAs so that we get a better sense of what's the true what's a truer picture of debt sustainability in the Caribbean for small island economies that face repeated uh, climate shocks such as hurricanes. So I think that's a key piece that has to be undertaken, and that's within the purview of regional central banks. And then when you do that, then you could start to do some joint stress testing because when Hurricane Beryl, for instance, hit the Caribbean in 2024, it didn't only hit Grenada, it also hit St. Vincent. And there was some spillover effects on Jamaica. So it starts to go across one island to the broader Caribbean. And that's why I think joint stress testing of these climate shocks would become important. And then the Caribbean needs to do a lot more uh, work with some global institutions, such as the Alliance for Financial Inclusion. The, the Alliance is a global network of central banks and financial regulators who are concerned about how climate shocks hit vulnerable communities and households. And
Right.
therefore, what sort of financial products and services are actually needed to provide the kind of protection, right, in the face of climate shocks? I, and they've been working on a whole new uh, thematic area called inclusive green finance. And I think this is where Caribbean central banks need to start to come into play. And why I say that too is also because we have a lot to teach the world in the area of financial innovation. Because it is in the Caribbean where the world's first regional catastrophe risk facility was created. Today it's called CRIF, the Caribbean Catastrophe Risk Insurance Facility. CRIF has now given birth to new facilities across the world, in the Pacific, in Africa. They've been created, built on the CRIF model. The Caribbean was the first to introduce what we call hurricane debt pause clauses into sovereign debt contracts. Grenada was the first country to introduce that when it did its debt restructuring in 2015. And Barbados then introduced it in when it did its restructuring a few years ago. And now you have the World Bank, IDB, and other MDBs introducing these sort of what we call sovereign contingent debt clauses into their debt contracts, right? So there's financial innovation happening. So it's not only that we could learn from the rest of the world, the rest of the world could also learn from us. Yeah.
Yeah. Looking ahead, what should be the main priorities for Caribbean central banks over the next 3 to 5 years, in your opinion, Jwala?
Hmm. I would I would actually suggest three main priorities for Caribbean central banks. First, on climate and transition risk, I think Caribbean central banks need to integrate those into their monetary, prudential, and supervisory models. Because, as I said, those are critical risks facing the region, not only at the individual small island economy, but at the broader regional level. So, how do we incorporate climate and transition risk into forecasting, stress testing, reserve management, collateral frameworks? I think that is going to be extremely important. The second is around the financing and the deeper financial markets, the deeper capital markets that are needed, because the the monetary policy frameworks in particular operate through the capital markets. And therefore, we need to build out deeper markets, particularly deeper bond markets are required.
Yeah.
Yeah. And that is not, and when that is done, it also means that you could then start to maybe build a more resilient cross-border payment system that could deal with climate shocks when they hit a particular jurisdiction. And the third area I would really like to see Caribbean central banks become more involved in is becoming more influential architects of global financial reform, because we need the reform that introduces changes that are more fit for our purpose in the Caribbean. And I've talked about them, like greater access to development finance based on vulnerability, not based on income. How we introduce more disaster clauses, debt pause clauses into our sovereign debt contracts. How do we improve debt sustainability analysis? Right? Those I think those are technical areas where central banks have the expertise and they could serve the region quite well. And a final area is how we could think about creating a stronger regional financial safety net where Caribbean central banks come together, same way, pool some resources that are available to provide to the broader membership when these sort of climate shocks hit. And then that becomes a intermediate step to thinking about the greater picture of a broader monetary union in the Caribbean.
So when you talk about deepening the bond market, Jwala, do you mean the secondary markets for corporate debt?
On yes, because what we've seen is outside of Jamaica and Trinidad, the capital markets and particularly the bond markets are not really fairly well developed or established. And countries like Guyana, which is now developing and growing out and growing tremendously, they would require a sort of financial structure where there's a well-developed bond market to provide the kind of liquidity that's needed to various entities, not only its financial sector, but those private sector players that require, let's say, a repo line of business to provide short-term liquidity while they go about doing their operations. Those are the sort of things that are needed. And then will also help um, a country like Guyana, which has a strong development strategy in terms of uh, um, carbon finance and conservation of forests, the Amazon forest, how you might be able to then float out, let's say, green bonds, blue bonds in that context, right? And then
Right.
just generally for the Caribbean, it is not a space where sustainability linked bonds have been, you see them happening, right? So I think it's a space where green and blue bonds, for example, could be, we could see more issuance of those in furtherance, and then how central banks are key to helping build out those sort of capital markets. Yeah.
So the central banks would be leveraging their own balance sheet in this
You at
context.
some points, if need be, you could do that, but there's a context in which it's done. The Central Bank of Trinidad and Tobago has actually been a major architect of developing the capital markets in Trinidad. And it has managed to do that without actually using its balance sheet really, but
Right.
using the influence of the central bank in getting things done. Yeah.
Okay. Understood. Understood. Yeah. I
Mm,
think that's the only way these new initiatives are
mm,
actually, they take on the bandwagon and then they become successful.
Yes, yes, yes. And we need champions. Yeah, we need
Yeah,
champions and we need leaders, strong leaders and leadership. Yeah.
absolutely true.
Mm.
So you have contributed to the Bridgetown initiative, Jwala, and broader reforms of the international financial architecture. Please share
Mhm.
more details of this initiative in the context of the Caribbean region.
Uh, yeah, the Bridgetown initiative is one that came about from Prime Minister Motley of Barbados. She recognized that same thing. There was need for us to start to reform the global financial architecture, given all these issues that we've discussed. And Bridgetown has taken three iterations so far. But the core proposition of Bridgetown is that more development finance, including climate finance, should be flowing to developing countries. And Bridgetown really has outlined a number of ways in which that could be done, some of which I've actually discussed, and including the fact that there needs to be more private sector capital coming to the table because the private sector hasn't really been a major player so far. We've more or less depended on public money. One way we actually see Bridgetown playing off would be in the sort of debt swaps that Barbados has implemented over the last few years. The last debt swap in particular was a sort of debt for adaptation swap in the wastewater sector that brought private sector financial players into the transaction. So it actually showed that you could do a debt for resilience swap, and it showed that you could bring the private sector to the table. So there were two major demonstration effects. Um, Regarding Bridgetown and some of the other issues, in terms of my work, a lot of that has been around either debt swaps, creating regional financial arrangements like the Lifeline Fund, um, also advising on the sort of blue bond financing that might be needed for countries. So it's really been around the financing side and some of the work on Caribbean civil society on at a more broader level, introducing the whole notion of reparatory justice into the global financial landscape and climate reparations as one dimension of reparatory justice for small island economies. Because the key argument there is that we've contributed the least to global emissions,
Yeah,
but we face the greatest harm from it. Yeah.
right,
And I've introduced a whole notion of climate debt into the argument to show how we link that climate debt and the loss and damage that arises as a way of how we could start to treat with reparatory justice in the Caribbean context. Yeah.
right. So this reparation would be from the G7 or the G20? I mean, how does that work?
Well, it works across the broader argument is that you have developed countries that did commit and make a pledge in Copenhagen in 2009 to provide 100 billion in worth in climate financing to developing
Yeah.
countries, right? And we've always had issues around whether that 100 billion number was met, how it's
Mm.
counted, that sort of thing. But even if we accept that it was eventually met, much of that climate financing has come in the form of loans, which means it is then raising the debt profile of the very same countries that the financing was meant to remedy an issue. So there's a major challenge there. There's a major asymmetry that exists to start with.
Right.
So, but to answer the question, whether it's the G7 or the G20, it's at the broader developed countries and the fact that a commitment was made. Yeah, and therefore, how do we then address that in the context of reparatory justice? Mm.
Now, you have helped governments on sovereign debt restructuring, climate resilience, and macro financial transformation,
Mm.
along with just transition finance through
Mm.
fossil fuel treaty initiative.
Mm.
Can you share experiences so far?
Yes, yeah. Well, it's a broad experience on the intersection of sovereign debt, climate vulnerability, financial stability, and essentially structural transformation, because all these things eventually come to the end of how do you build greater resilience for small island economies. And I could share like one of the lessons that we've seen from the debt restructuring is that restoring liquidity is not enough because much of the debt restructuring is around the liquidity side. But
Right.
restructuring has to start, especially in the context of small island economies in the Caribbean. It has to start looking at how do we reduce the refinancing risk because Caribbean countries have repeatedly restructured debt. Um, in the last 20 years, we've had close to 20 sovereign debt restructuring. So that's on average one debt restructuring a year, right? So we need to think beyond just liquidity to how do we reduce the refinancing risk? How do we protect the sort of essential investment that is needed? How do we incorporate mechanisms such as hurricane debt pause clauses into these contracts so that we prevent the next shock from immediately recreating a crisis? And I think those are
Right.
some of the key pieces on debt restructuring as a lesson. Um, the other part is around when we talk about macro financial transformation, what do we need of our central banks and also our finance ministries? And I think is we need them to understand how changes in energy, trade, and technology affect the mandate of central banks in terms of price stability, monetary stability, exchange rate stability, and overall sovereign risk itself, I think, and what those channels look like. Um, and then there's some of the work that is now coming through from on the transition risk side. I am a co-founder of what has been the newly established, we call it the Santa Marta Transition and Financial Stability Group.
Right.
It's called Smart FSG, and what that group does is really I would call it a community of practice that is looking to support central banks and how they treat with the transition risk. Because while we've talked broadly around climate, the transition side hasn't really been fully addressed, which is how do you reduce that dependence on fossil fuel energy, right? And
Right.
I think that in itself is one that we're starting to see coming more and more to the fore. You look at what's happening with Europe right now and the wildfires, and the fact
Yeah.
that even European Central Bank has said, I think we need to start thinking about how climate risk is incorporated into collateral frameworks. You're starting to see
Right.
a discussion, coming. So I think that's key about apart from climate risk, how do we now start to think about looking at transition risk? And is recognizing you're not asking central banks to manage energy policy. You're asking them to manage a risk that is macro critical in nature, right? And so whether it's around debt restructuring, climate resilience, macro financial transformation, or even the just transition finance that we were talking about, much of my work is really around how do we connect high level reform proposals to
Yeah.
implementable solutions, right? And how do we then design the sort of institutional framework and governance framework that's needed so that you have clear mandates, you have measurable triggers, you have proper governance, you have appropriate financing, you have risk that's allocated properly, and accountability that is also measured and transparent. So it's how you bring something that at that high level to something that we could implement and live with. Yeah.
So are Caribbean commercial banks a signatory to the Basel regulations?
Yes, yes. Yeah, we've
Okay.
Central Bank of Trinidad and Tobago, for instance, is starting to roll out on Basel 3, some elements of 3 already. Yeah,
Okay. Okay.
yeah. It's slow. It's a slow process though. Yeah.
Yeah.
Mhm.
Finally, Jwala, I know this is a is a relatively new concept, but can you give a brief overview about the strategy pertaining to the rollout of CBDCs and their role in the Caribbean economy's digital
Mhm.
integration
Mhm.
as a process in the preparation for the future?
Mhm. Yeah. Well, a few central banks in the Caribbean have experimented, I would say, or look to sort of roll out CBDCs. I would say the most advanced has been the Eastern Caribbean Central Bank with what is called DC Cash. Then you have Barbados has done some good work on its digital currency framework. And you have Bahamas, which did attempt some rollouts, and I think there's some lessons there in terms of it didn't reach as far as possible. But I think what is important is that Caribbean central banks need to look at CBDCs um, not as a technology project, and you got a sense that it was almost like a race to be first to roll out.
Right,
But as part of a broader digital finance strategy that could strengthen resilience in the Caribbean. And
right,
and that's really resilience around everything that's needed in terms of the legal framework, cybersecurity, digital identity, consumer protection, right? And even how you get uh, private financial institutions, the private sector, and the communities themselves to participate in the projects, right? So I think it has to be
right.
treated like that again, more at a macro type level, and not as, oh, this is just technology that we're rolling out and it's going to make us more efficient from a payment system point of view. There's a lot more that could be done, especially when we've talked around the sort of regional initiatives that Caribbean central banks need to get more involved in. And and I think this could be one rather than each central bank attempting to roll out its own CBDC. Could we speak to a more regional CBDC, right? As part of a regional financial safety net, and then seeing it evolving as part of when you start to think about um, an overall digital currency for the Caribbean.
Well, on that note, that's all I have for
Mhm.
today. Thank you very much for being part of the show, Jwala.
Mhm.
It was indeed a great honor to have you on the show.
Sure. Thank you so much, Karan. It was my pleasure to be on your program. I really enjoyed the questions. I enjoyed the discussion, and certainly look forward to our next collaboration. Thank you so much. Yeah.
Thank you so much,
Mhm.
Jwala.